Whether it's planning for retirement, saving for a college fund, or earning residual income, individuals need an investment strategy that fits their budget and needs. Investments in real estate and buying stocks is a good place to start. Hey go-getters, welcome back to The Early Investors, another profitable episode where you can learn how to become financially free. In today's video, we'll be discussing 2 investments that you need to make and never worry about money again. Want to become the next Warren Buffett? Stay with us to find out all the tips and tricks to save your hard-earned money. Before we jump into the video, make sure to subscribe to our channel for more business-related content. Investing is an essential part of wealth creation, which helps you beat inflation to fulfill your financial goals and stabilize your financial future. Instead of letting money lie idle in your bank accounts, you can invest in different avenues like stocks, equities, mutual funds, fixed deposits, and more. The 2 investments we'll be talking about today are real estate investments and stocks or index fund investments. Real estate basically involves the purchase, ownership, management, rental, and/or sale of real estate for profit. Improvement of realty property as part of a real estate investment strategy is generally considered to be a sub-speciality of real estate investing called real estate development. Investing in real estate or stocks is a personal choice that depends on your financial situation, risk tolerance, goals, and investment style. It's safe to assume that more people invest in the stock market, perhaps because it doesn't take as much time or money to buy stocks. If you're buying real estate, you will have to save and put down a substantial amount of money. When you buy stocks, you buy a tiny piece of that company. In general, you can make money 2 ways with stocks: value appreciation as the company's stock increases, and dividends. When you buy real estate, you acquire physical land or property. Most real estate investors make money by collecting rents, providing a steady income stream, and through appreciation as the property's value goes up. Aspiring real estate owners can buy a property using leverage, paying a portion of its total cost up front, then paying off the balance over time. One of the primary ways investors can make money in real estate is to become a rental property landlord. Owning rental properties can be a great opportunity for individuals with DIY and renovation skills and who have the patience to manage tenants. However, this strategy does require substantial credit to finance upfront maintenance costs and to cover vacant months. Rental properties provide regular income, and the best part is the properties appreciate over time if the conditions are favorable. For those of you who are unaware of leverage, it is basically an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital, to increase an investment's potential return. This investment strategy is a common practice among real estate investors for owning a property. People who are flippers, buying up undervalued real estate, fixing it up and selling it, can also earn income. House flipping is for people with significant experience in real estate valuation, marketing, and renovation. House flipping requires capital and the ability to do or oversee repairs as needed. This is the proverbial wild side of real estate investing. Just as day trading is different from buy and hold investors, real estate flippers are distinct from buy and rent landlords. Case in point, real estate flippers often look to profitably sell the undervalued properties they buy in less than 6 months. There is another kind of flipper who makes money by buying reasonably priced properties and adding value by renovating them. This can be a long-term investment where investors can only afford to take on 1 or 2 properties at a time. Flippers who cannot swiftly unload a property may find themselves in trouble because they typically don't keep enough uncommitted cash on hand to pay the mortgage on a property over the long term. This can lead to continued, snowballing losses. As an investor, you may want and need to consider hiring a contractor to handle repairs and renovations of your flip, or a property manager to oversee the upkeep of your rental. This may cut into your bottom line, but it does reduce your time spent overseeing your investment. Real estate investing platforms are an option for those who want to join others to invest in a bigger commercial or residential deal. The investment is made via online real estate platforms, also known as real estate crowdfunding. It still requires investing capital, although less than what's required to purchase properties outright. Online platforms connect investors who are looking to finance projects with real estate developers. In some cases, you can diversify your investments with not much money. Whether real estate investors use their properties to generate rental income or to bide their time until the perfect selling opportunity arises, it's possible to build out a robust investment program by paying a relatively small part of a property's total value upfront. And as with any investment, there is profit and potential within real estate, whether the overall market is up or down. Moving on to the second investment, investing in stocks is an excellent way to grow wealth. For long-term investors, stocks are a good investment even during periods of market volatility. A stock market downturn means that many stocks are on sale. One of the best ways for beginners to get started investing in the stock market is to put money in an online investment account, which can then be used to buy shares of stock or stock mutual funds. With many online brokers, you can start investing for the price of a single share. Most investors do not take a huge cash infusion to get started in the stock market, making it an appealing option. Unlike real estate, stocks are liquid and are generally easily bought and sold so that you can rely on them in case of emergencies. With so many stocks and ETFs to choose from, it can be easy to build a well-diversified portfolio. Going the DIY route? Don't worry, stock investing doesn't have to be complicated. For most people, stock market investing means choosing among these two investment types: stock mutual funds or exchange-traded funds. Mutual funds let you purchase small pieces of many different stocks in a single transaction. Index funds and ETFs are a kind of mutual fund that tracks an index. For example, a S&P 500 fund replicates that index by buying the company's stock in it. When you invest in a fund, you also own a small piece of each of those companies. You can put several funds together to build a diversified portfolio. Individual stocks. If you're after a specific company, you can buy a single share or a few shares as a way to dip your toe into the stock trading waters. Building a diversified portfolio out of many individual stocks is possible, but it takes a significant investment. The upside of stock mutual funds is that they are inherently diversified, which lessens your risk. For the vast majority of investors, particularly those who are investing their retirement savings, a portfolio composed mostly of mutual funds is a clear choice. Stock investing is filled with intricate strategies and approaches, yet some of the most successful investors have done little more than stick with the basics. That generally means using funds for the bulk of your portfolio. Warren Buffett has famously said a low-cost S&P 500 index fund is the best investment most Americans can make, and choosing individual stocks only if you believe in the company's potential for long-term growth. In our view, the best stock market investments are often low-cost mutual funds like index funds and ETFs. The best thing to do after you start investing in stocks or mutual funds may be the hardest. Don't look at them. Unless you're trying to beat the odds and succeed at day trading, it's good to avoid the habit of compulsively checking how your stocks are doing several times a day, every day. To sum up, real estate is an asset form with limited liquidity relative to other investments, and it is also capital intensive. However, capital may be gained through mortgage leverage and is highly cash flow dependent. If these factors are not well understood and managed by the investor, real estate becomes a risky investment. According to the US Census Bureau data, sales prices of new homes, a rough indicator for real estate values, consistently increased in value from 1940 to 2006, before dipping during the financial crisis. Subsequently, sales prices resumed their ascent, even surpassing pre-crisis levels. It remains to be seen what the long-term effects of the coronavirus pandemic will be on real estate values. The stock market is subject to several different risks: market, economic, and inflationary risks. First, stock values can be extremely volatile, with their prices subject to fluctuations in the market. Geopolitical and company-specific events can cause volatility. Say, for instance, a company has operations in another country. This foreign division is subject to the laws and rules of that nation. Real estate and stocks have different risks and opportunities. Real estate is not as liquid as stocks and tends to require more money and time. But it does provide a passive income stream and the potential for substantial appreciation. Stocks are subject to market, economic, and inflationary risks, but don't require a big cash injection, and they generally can be easily bought and sold. Investors, it's time to wrap up, and thank you for watching to the very end of the video. Uh-oh, did you forget to smash that like button? Well then, just gently tap that like button now. And don't forget to check out other videos and share your thoughts in the comment section. catch you all in the next one.